Okay, so welcome to our recorded tutorial session for inventory cost flow. We will talk about three major cost flows. We have first in, first out, last in, first out, and uh, moving average. Alright, so this is an example problem I extracted from a textbook. Okay, so we have music sheet.net specialized in sound equipment. Because each inventory item is expensive, Music Sheet uses a perpetual inventory system. Company records indicate the following data for a line of speakers. Okay, and then we have given this table. Now it's important to point out the system, okay, inventory system that they're using, okay, because it also affects how you will prepare your inventory ledger later on. And also, importantly, that will affect the costing of the inventory sold. Okay, we were required to prepare or determine the cost of goods sold and ending inventory using first in, first out, and last in, first out. Okay, so we'll go to the details first. Okay, we have a balance of 18 units or quantity, and then that will be at $34. And then we purchase on 2nd April 6 units or 6 quantity at $65. And then we had a sale on 7th and 13th, 9 and 6 units respectively, and the sales price will be fixed at $122. So let's first discuss about first in, first out. Okay, so you can see here, first April, I have 18 units, unit cost of $34, so the total cost will be $612. You can see that in that April 1 or April 1st row. So the balance will be 612, of course, okay, for that opening balance. And then as you can see, on 2nd April, we purchased 6 units at a cost of $65, and then the total will be $390. Okay, so you can see there will be three major divisions here: purchases, cost of sales, and balance. So that 6 units will be carried to the balance, as you can see there. So of course that 18 units will be there, we haven't sold it yet, and then we have 6 units or 6 quantities. Of course they have different prices. You can see 6 units, it has a total cost of $390. Okay, so we have $1,002 in total. That will include the opening balance a while ago. Then we have the sale. Okay, so on 7th April, we have a sale of 9 units. Okay, so you can see here, and because we're using first in, first out, the first item that we had purchased will be the first one should be out, okay, of our business. So what it will illustrate here is that because we still have 18 units from our opening balance, so we will get that costing of that 9 units from the opening balance. Okay, so 9, of course, multiplied by unit cost, you have 306. Then you will see in the balance section, instead of 18, we only have 19 for that $34 unit cost. And then the 6, we still have it because we based on first in, first out, it will not be out yet until we had eliminated all the items at the beginning or the earlier purchases. So for the 9 units, we still have $306. For the 6 units, which costing $65, we have $390. So the total or the balance of our inventory will be $696. And on the 13th April, we have sold 6 units. Now the costing of that one will still be coming from the opening balance because we still have remaining units. Remember, we only sold 9 units last April, April 7, so we still have 9 remaining from that balance. So the costing for these 6 units will be coming from that 34. The unit cost will be 34 coming from the opening balance. And then if you look into the a balance section. So out of that 9, we deducted 6. We still have 3 with a unit cost of $34. So we have 102 there. And then 6, of course, is untouched still based on the inventory cost flow. So we have a total balance of 492. So that closing inventory here will be costing $492. Cost of sales will be 510, and the purchases that we made is 390. Alright, so let's look into the last in first out. Okay, as you can see, we're using the same transaction. Okay, so April 1st, we still have that 18,000 there. And then on 2nd April, we purchased 6 units at $65 per unit. So we have this. Almost the same with the first in first out. Now, the changes will come from starting from 7th April. Okay, so in this case, we purchased we sold 9 units. Out of 9 units, we need to know how much is the cost, okay, our cost of sales. Now, in the rule on last in first out, the last purchases will be the cost or the costing of the sale, okay, the recent one, and then followed by the second recent one. Okay, so in this case, the costing of the sale, okay, of that 9 units, out of that 9, the 6 will be coming from the 65, the recent purchases, okay, or the recent purchase. So in this case, $65 will be the cost of that 6, and the remaining 3 we will go up, and the basis of that costing will be on the second recent purchases or the recent balance or the amount, which is the unit cost is 34. Okay. Alright, so which means we still have 15 units out of that 18 from the opening balance. And then 13th, we have sold 6 units. The costing of that one will of course be coming from the recent purchases, but in this case, of course, coming from the opening balance. So that will be $34. So the balance here of the inventory will be $306, and then cost of sales will be $696, and then purchases will be $390, just the same with first in first out. Now in case we use moving average, okay, in moving average what we do is whenever we have a new purchase, we try to recalculate the unit cost, okay, based on the average of course, based on the calculation average cost of the units held, okay, over the total cost of the inventory. So in this case, we have 1st April, that's the balance, just the same. 2nd April, we had purchases of 6 units with the unit cost of 65. As you can see here, the total units that we are holding on as at 2nd April will be 24, and the total cost will be 612 plus 390. That will be $1,002. So we need to know how much is the average unit cost. To know that, get the total cost, divide the total number of units that you're holding on, and the result will be the average costing. If you go on to the 7th April transaction, we have a cost of sale, we have a unit that we sold, 9 units. And then the unit cost that we will use is that $41.75, the revised unit cost. And then it will go on until the 13th, you can see there. Okay, we use the same unit cost. Purchases just still remains the same, the total will be 390. Cost of sales will be $626.25, and the balance of our inventory will be $375.75. If we do the comparison of the methods, we have the sale, of course, that will be 15 units. The sale price per unit will be $122. Cost of sales, you can see the comparison here. First in, first out is 510, while last in, first out it will be 696. Moving average will be $626.25. The tendency of the average method is trying to make sure the price will be fair. Why? Because as you can see, the prices are the price or the cost difference between the opening balance and the closing balance per unit, the cost will be quite huge. Okay, recent purchases, that will be quite huge. So the moving average tends to help just to make it fair. Now, in cases of rising prices, last in, first out in our illustration will show a lower profit. Okay, comparing with first in, first out. And that's one of the reasons why last in, first out in some jurisdictions is actually quite, or it's actually prohibited, because normally the prices of the products will be going up. So it will not really produce, or it can be abused, okay, especially if they want to reduce their chances to pay taxes. Okay, as we know, the base of the tax will be the profit. And in the closing inventory, as you can see, last in, first out had the lowest inventory costing here, because the basis of that one is the earlier purchases. Unlike in first in, first out, the costing of the closing inventory will be based on the recent purchases. And that's it for my recorded tutorial lesson. I hope you learned something.